go through some of the top stories that have been making headlines on the Ugandan scene and as well as the East African region concerning financial markets. And we start with the weakening shillings and how the Ugandan shillings has been losing value against the dollar. Now, we have had this story for quite some time because the Ugandan shillings has been very strong over the last couple of years. Even during COVID-19, it remained resilient against the dollar. But recent studies by Bank of Uganda have actually shown that it has started weakening, and this has created a lot of worry. Now, the Uganda shilling is currently under a lot of pressure against many other currencies as well, and especially the United States dollar. Now, I want to explain a little bit more of why the currency value is getting eroded and how one can hedge against this loss. So, money can be anything that can serve as a store of value, which means that you can use money as savings to use later. However, when prices go down, which is called deflation, you have a higher, chance of purchasing more goods. Now, when there is more money in circulation, but the same level of demand for goods, the value of the money will drop because people have enough money to purchase exactly what they want. The demand on the goods, the pressure of demand on the goods increases, and the goods become scarce. When goods become scarce and people still have more money, it means they are willing to part with more money to just access the same amount of goods or services that they would access naturally. Now, this is inflation, and we are experiencing inflation right now in the country with the average rise of prices. Now, this means that you need more money to just get exactly the same amount of goods you would need with less money. The impact of inflation may seem small in the short run, but in the long run, over the years, it may erode the purchasing power of your savings. So you may not actually be able to purchase anything at all in the long run with the same amount of money you used to use to purchase some of those goods. Now, according to the Executive Director Research at Bank of Uganda, that is Dr. Adam Mugume, he says that money is a bad store of value, but money is a good medium of exchange. Yes? And money's loss of value largely reflects in the effect of inflation. What he's saying literally is money is a good, medium of exchange to use to actually access goods and carry out transactions, but it's a bad store of value, meaning when you store money, it doesn't keep the value. It doesn't store the value. And value is different from the money because value is what you can do with the money, but money is just money without any other thing attached to it. So whenever you store money, it doesn't store its value. If I store a 1,000 note today, if I stored a 1,000 note in 2007, a 1,000 note probably could get me a kilogram of sugar, in 2005 and 2007. But if I stored that money right now and I pulled out that note today in 2022, it will not get me a kilogram of sugar. So it has not stored its value. It has stored the value, the currency. It has stored that note of 1,000, but actually the value has reduced, and the value is that purchasing power of the currency, that ability to access goods and services through that money. Now, a case in point given by Dr. Mugume is that if the inflation, now he's saying that this loss of value in money is an effect of inflation. It's as a result of inflation. And he gave a case in point that if inflation averaged 2.2% in 2021, ideally that is money lost value by the same magnitude. So he said, giving an example of 100 million shillings, that if you stored 100 million shillings in 2021, and that money did not earn interest, you probably just stored it somewhere, today that amount of money would have a value of 97.8 million. Meaning it has lost a value by 2.2%. So the money is still 100 million, but what it can purchase today is actually worth 97.8 million. Now, that is what we are experiencing in Uganda right now. We still earn the same way. People have not actually gone broke, but actually what we earn can no longer be sufficient to purchase what we used to purchase before inflation came into play. This is exactly what is affecting the currency. Now, therefore, one ought to minimize holding cash. This is according to Dr. Mugume, who is the research director at Bank of Uganda. Instead, you should hold money in an account that earns an interest rate that is higher than the inflation rate. Yes? Now, he's saying instead of holding cash, because he says cash does not store value, cash alone does not store the value. You would rather actually invest that money in some sort of account, like a fixed deposit account that earns interest. Yes, that earns interest. And some of these things we talk about every day here on the program. Collective investment schemes, treasury bonds and bills. Now, instead of storing that money during these very turbulent times, turbulent economic times, where the economy is beleaguered, we would rather actually invest that money in some sort of asset or instrument that earns interest. That way, our value. And this is exactly what the Bank of Uganda is actually advising us to do. Now, moving on, he says that almost 50%, this is Dr. Mugume, he says almost 50% of deposits in banks are demand deposits accounts, and that earn almost zero interest rate. Now, what is a demand deposit account? A demand deposit account is a bank account where one can access their money anytime they feel like and can pull out that money and use it. It is more of, it's not a savings account per se, but it's an account where one just keeps money there without any yielding any interest, but just keeps money there for use. Yeah, you can pull it out anytime you want. Now, most of us, 50% of us who have bank accounts have such accounts. And as the demand for a particular good or service increases, the available supply decreases. So if we are keeping this money in the bank and it's not yielding interest, we are going to lose value with this money, because inflation is going to exceed the interest rates. And sometimes, as we have said, there's no interest rate on such accounts like the deposit demand deposit account. And that will create more problems for our currency against other currencies. So as we move on, as the demand of a particular good or service increases, the available supply decreases. Of course, demand is your need for that good. If it increases and people are putting a lot of pressure on the good, of course the goods will run out and the supply will be cut. Now, when fewer items are available, that is, if the supply is reduced, consumers are willing to pay more to obtain exactly the same item, as outlined in the economic principle of supply and demand. Now, the idea of saving money or spending it on a number of things to support your long-term or short-term goals is a little difficult now, because there's a shortage in goods due to the hiking prices and people can no longer afford them. So it's a little bit more difficult for you to save and invest. The diminishing value of the shillings as a result of rising inflation could mean cash halving in value. If prices increase, it means the value of the currency has eroded and its purchasing power has actually fallen. Now, back in the days, the value of the Uganda shillings was strong, but since the year started, the cost of some goods and services has more than doubled. In an interview with one of people called Mr. Amos Zambari, he said the Rolex used to cost at least 500 shillings some time back, but today it costs over 2,000. I don't know, those are like 2 eggs and 1 chapati, something like that. It's costing 2,000 because the value of the money has reduced, so you need more money to purchase the same item. Now, the price of all items has increased, and not excluding the Rolex and all the other factors. And as cited earlier, money exists as a store of value. Employees trade the value of their working labor for a representative amount of money in wages, and then trade that representative value for other goods and services. Currency depreciation is a fall in the value of a currency in terms of exchange rates versus other currencies. Some of the leading causes of currency depreciation are low export earnings, revenues accruing from commodities, surge in imports, high interest rates or reduced monetary policy interest rate, and traders and speculators selling currencies on the market. Now, we are seeing a decrease in the value of our currency simply because of these four factors. The decrease in exports, because we are not a major exporting country. We are a major importing country. We import more than we export. So we realize that we have to trade our shillings. So as we buy dollars, so as we purchase those goods and then import them into the country. Now, whenever you sell off your currency, buying another currency, you put the other currency on demand. You put probably, let's say, the dollar, because most countries will prefer, using the dollar for their exchange. And whenever you buy the dollar, we actually are putting the dollar on demand. We are making the dollar, short. We are making the dollar reduce in terms of quantity on the market. So when the dollar is on demand, the average price of buying the dollar using your currency will actually increase, meaning you will need more shillings, or you will need more Uganda shillings to purchase just a single dollar. Now, when that happens, it means the value of your currency is going down against the other currency. And this is exactly what we are experiencing right now. Now, a fall in the purchasing power due to inflation reduces consumption and hurting industries, and imports also become costlier. So, meaning people are going to have a fall in the purchasing power. People are no longer buying as much as they used to because they can no longer afford it. And now this reduces consumption. Now, when the consumption of goods reduces, when you're no longer buying those cookies you used to buy probably going home, that baker who has been doing the cookies in Entebbe probably will actually see that he will reduce the amount he's producing. Now, that hurts the industry, because now when we produce less, it means we actually are becoming less productive. This reduces our gross domestic product, and it's not good for the country. Now, the executive director of Uganda Manufacturers Association, Mr. Daniel Birungi, says that when it comes to the shilling losing value, the problem is largely a macro problem in nature and is determined by a number of factors. A case in point is our dependence, as we have said, on imports and the constantly varying interest rates and risk aversion among investors, among other factors. Yeah, so he says we rely on imports a lot, and also we are seeing constant changing interest rates. As you remember, Bank of Uganda lowered the interest rate during COVID-19 around 2021, in mid-2021, so that banks could access money at a low interest rate, so they could lend at lower interest rates for people to recoup their businesses, for people to rejuvenate their businesses after the pandemic shocks. But now we are seeing that the interest rate of Bank of Uganda is actually going to increase, because as well inflation is taking lead. And so due to all these other factors, the shilling is being affected. He, however, quickly noted that to ensure that money gains value, we have to first reduce importation of items, especially for sectors where the country has developed capacity to produce finished goods in sufficient quantities locally. So we should reduce on our importation if we are to address the value of our currency being beat by other currencies. And we reduce the importation by trying to promote our own. Yes, this would greatly reduce the import bill and have some control on the shilling value. We championed the Bank of Buy Uganda, Build Uganda, that is BUBU policy, to increase the market for our locally made products. That's according to Mr. Birungi there. So he reveals that they have also engaged the Public Procurement and Disposal of Public Assets Authority, PPDA, to increase the threshold on the reservation guidelines to include sectors that have grown capacity along their various value chains. Now, this will help us to curb the importation and promote our, very own locally produced goods. That way, whenever you buy a shirt made in Uganda, you're saving the currency, you're saving inflation, you're reducing inflation, because that way you are reducing what we import. The pressure on people to import goods from other countries where we need dollars is reduced, and that way we can always use our own currency here and promote the growth of our currency. In conclusion with this, because what can we do as financial markets enthusiasts to see that we at least hedge ourselves, protect our assets against this turbulent currency? One thing we can do, according to Bank of Uganda, is currency hedging. Now, the Western Union Global Market Money Transfer says that currency hedging is the act of entering into a financial contract in order to protect against unexpected or expected anticipated changes in currency exchange rates. It's used by financial investors and businesses to eliminate risks they encounter when conducting business internationally. Hedging can be likened to an insurance policy that limits the impact of a foreign exchange risk. So due to the unforeseeable currency risks, some financial analysts advise people or companies to do currency hedging. Now, currency hedging is simply kind of getting like an insurance. It's analogous to an insurance policy that covers your assets, that covers your business from these foreign exchange risks that come with using the currency. So that is one way we can use to protect our assets from these risks that keep coming in due to the foreign exchange. Another way we can actually protect the currency, according to Bank of Uganda, is currency pegging. Now, besides hedging, there is the currency peg. Now, currency pegging is when a country attaches or pegs its exchange rates to another currency or a basket of currencies or another measure or value, such as gold. Pegging is sometimes referred to as a fixed exchange rate. A currency pegging is primarily used to provide stability to currency by attacking its value in a predetermined ratio to a different and more stable currency. This has been done in Uganda as well. For over the 30 years now, there has been considerable diversity in exchange regimes of developing and transition countries, from very hard currency pegs to relatively free floats. Now, what the currency peg is doing is you attach your currency to another stronger currency, for example, the US dollar, and you form a basket, which is something rare, but at least for countries that have really suffered with their currencies, they have tried it and it has worked out to redeem the country. So you kind of attach it to that currency and they work hand in hand. That way, the other stronger currency can uphold the weaker currency, and this can influence some of the factors that affect the currency. That's the story right there to look out for. If you have that shilling, please save it, because the shilling is dwindling, and we need to find ways to secure our currency from these turbulent economic times and the beleaguered economy and inflation and the Russian and Ukraine war. So as we can, as a country, maintain the economy at such a favorable and workable level. Moving on, the KCB Group has named a new CEO, and that is Mr. Paul Brusso, and he is succeeding the managing director who has been managing director for over the past 9 years, and that is Mr. Oigara Joshua. Now, Mr. Russo has served as the group head of human resource before being appointed to run National Bank Kenya in 2019. He has been a former managing director of the company's subsidiary, that is the National Bank of Kenya, which was acquired by a Kenya commercial bank in 2019. And now he has been appointed the CEO or the managing director of the Kenya Commercial Bank. After being nominated, because he was the human resource first at KCB, then he was nominated to run National Bank Kenya in 2019. Then he has also previously served at Barclays Bank, or now commonly known as Absa. So Mr. Russo also takes over at the second biggest lender by assets from the long-serving boss Joshua Oigara, whose term expires in December. Now, Mr. Russo served as a group head of human resources before being appointed to run the National Bank of Kenya in 2019 after KCB completed the acquisition. He also previously served at Barclays Bank, that is Absa, and audit firm PwC. The lender, that is Commercial Bank, Kenya Commercial Bank, in March quietly extended the term of Mr. Oigara by a year to allow it to search for a successor. The extension ran until December 31st. Was the second extension for the 47-year-old man who earlier had said he was open to ending his 9-year term by the end of last year. Mr. Oigara was announced first appointed to this position in January 2013, and his term has been the most rewarding, benefiting from the performance-based pay that has cemented his position among Kenya's top-paid chief executives. Now, KCB, which also operates in neighboring countries like Uganda here, Tanzania, Rwanda, Burundi, South Sudan, has returned to double-digit profit growth for most years since he was hired. He has more than tripled the bank's asset value from 390 billion shillings, that is 3.3 billion US dollars, in 2012 to 1.22 trillion Kenya shillings, that is 10.45 billion US dollars. That is more than triple. Wow, I think he was quite a man there. And the bank's net profit stood at 34.26 billion when he was elected in 2021. Right now, before he resigned, the profit stood at 34.26 billion. That is from 19.6 billion Kenya shillings a year ago. And I think he's someone to watch out for. And we see how the Kenya Commercial Bank will be operating under him. Now, Kenya Commercial Bank, as you have seen, is one of the listed companies on the Nairobi Stock Exchange, as well as cross-listed on the Uganda Securities Exchange, and has been performing quite well over the past couple of years. But we've had now a new CEO, and we hope to see the company grow. And one time probably they'll have to come here and give us a little bit more about what they do. Now we are going to go into a short break. Like I promised, we are going to have Mr. Martin Owini. We had an interview with him, and he was explaining the role of you as an investor in your investment in the capital markets, and he was giving the Capital Markets Authority point of view. Don't go anywhere, stick around. We return after this short break.